Happy Friday out there, folks. This is Darius Dale here to present our macro minute for Friday, August 26, 2022. Starting with markets, we have stocks up this morning, commodities up, crypto mixed, dollar down, global bond yields up, market moving headlines. So we got more mixed economic signals this morning from the PCE data, the July PCE data of the U.S. economy. The PCE Inflation Index, which the Fed uses for its inflation target, slowed more than expected in July as falling energy costs offset the spike in food prices. It declined 6.3% year over year from 6.8% in June. Core PC inflation also slowed more than consensus, coming in at 4.6% year over year from 4.8% in June. Personal spending, however, missed consensus estimates by 40 basis points, coming in at 0.1% month over month from a downward revision to 1% in June. And then personal income growth also missed consensus estimates by 40 basis points, slowing to 0.2% month over month from an upward revision to 0.7% in June. So getting some mixed signals there, but obviously from my perspective, the inflation data is what really matters this morning. We talked about that in great detail in our leadoff morning notes. We've been talking about this for several weeks now in our research, whether it be the leadoff morning notes or the around the horns, in terms of the leading indicators for core PCE, sticky CPI, median CPI, trim mean CPI, all pointing to today's river card, which is very clearly a very sharp and aggressive breakdown in core PC. We talked about that today in today's leading off morning note in terms of looking at it from a month over month annualized rate of change perspective and all the implications of that breakdown as it relates to the near-term direction of our asset markets and the medium-term direction of our asset markets. It might not be what you think, so definitely go check out that note if you haven't seen it. Anyway, shifting gears, it's showtime, ladies and gentlemen. It's a big day today. So Fed Chair Jerome Powell is set to speak at 10 a.m. Eastern from the Fed's annual symposium. I laughed out loud. I was listening to Market Huddle this morning. They were making fun of symposium. It's not a conference. It's symposium. It's symposium. They have their annual symposium in Jackson Hole, Wyoming today. The Fed is unofficially out of the forward guidance business, but the Fed is officially out of the forward guidance business, but obviously unofficially can't help itself. We expect Powell to push back against market pricing for rate cuts in 2023. The hawkish right tail of outcomes would include any discussion the FOMC is seriously debating the level of R star, which is the neutral interest rate, the real neutral interest rate, or its general reliance upon R star to set monetary policy. By targeting 2.5% as the neutral rate level, the FOMC will be reticent to blow past with incremental jumbo-sized rate hikes. The Fed is implicitly or explicitly, if you're a cynic, tripling down on its view that elevated inflation is being driven by largely transitory factors. And guess what? It might be. We've been talking about this in our leadoff morning notes, in our around the horns the last few weeks about how both the persistent camp on inflation and the transitory camp on inflation might ultimately be proven right, both of those camps, it just on different intervals. So it's, again, has obviously some major implications for asset allocation and positioning if the transitory camp is proven right by subsequent inflation data over the next 2 to 3 months. So all eyes on those inflation reports. That's the number one, number two, number three thing that matters to asset markets is U.S. inflation data. It's not to say that everything else doesn't matter, but I'll tell you right now, there's $2.2 trillion of excess liquidity sitting in that reverse repo facility out there that could obviously come back into asset markets if we start to get some really positive outcomes on the inflation front. And more importantly, really positive outcomes on the inflation front would also perpetuate Goldilocks from an economic standpoint. So this is a legitimate risk. It's one of the three reasonably probabilities from an economic standpoint as it relates to our base case, bull case, and bear case scenarios that we've outlined in our recent around the horns, in our leadoff morning notes, and in our macro Scatter report. So this is nothing new to 42 macro subscribers. If you're confused, definitely subscribe and check out the research. Anyway, big movers today. Bloomberg Agricultural Index. So as I say all this about Goldilocks, you got the agriculture index up another 1% this morning to plus 10% month over month. Pause for dramatic effect. Bloomberg Industrial Metals Index up 2% to plus 9% month over month. So just when everyone's catching up to where we've been on analyzing some of the deceleration, the momentum and the magnitude of an inflation deceleration that we're observing, crazy stuff we're seeing in the data time series, we're actually getting sneak stealth attack from ag and industrial metals, which may be followed by a sneak stealth attack and not so sneak stealth attack in a rising crude and energy prices once the Biden administration gets done buying votes with its SPR relief. release. So, this is a very dynamic, fluid situation. It may be the case that what we observed in July does not sustain itself. We talked about that in our round the horn last week. I'm not going to give you the spoiler alert. I'm not going to spoil the conclusion of that out of respect for our paying subscribers. But this is a very critical time, the next couple of months, in terms of inflation data, quantitative tightening ramping up. There's a lot of stuff going on over the next couple of months that we think you should be very, very glued and keened into from the perspective of monetary policy, because again, the range of probable outcomes and that distribution is as flat and wide as I've seen in recent years. So we're going to need some data to give us some clues as to where do we go next. But anyway, getting into our setup for today's trading, looking at our volatility adjusted momentum signals and probable ranges. U.S. dollar index, that is bullish FAMS, bouncing off the upper bound of its probable range there. Got about a percent to the downside, a little bit more than a percent to the downside, a little bit less than a percent to the upside. Gold bearish FAMS, getting closer to the lower bound of its range, about 1% downside, 2% upside. 10-year nominal treasury yield, that is neutral FAMS, almost overbought there. High yield credit spreads, that's bullish FAMS in the middle of its range. S&P 500 bullish FAMS, close to being oversold there. It's bouncing this morning. VIX bearish FAMS, close to being overbought. That's fading this morning. Nasdaq's bullish FAMS, same deal with the S&P. Russell bullish FAMS, same deal as the S&P. Bearish FAMS Bitcoin, 4% downside, 11% upside. Bearish FAMS Ethereum, about 9% downside, 15% upside. Shanghai Composite bullish FAMS is oversold. WTI crude oil neutral FAMS in the middle of its range. Ag bearish FAMS still overbought. It's been grinding on the upper bound of its probable range for nearly a month now. We like to say when securities grind on the upper or lower boundary of the probable range, it's usually a leading indicator for a phase transition in the volatility adjusted momentum signal conditions. So we're definitely watching this closely. Same state with ag industrial metals here, been grinding on the upper bound of its probable range for about a month now as well. So we were on the lookout for a break back to neutral VAMs for ag and industrial metals, which may be presaging a break back out to bullish VAMs in the coming months for crude oil once our commander in chief, our vote buyer in chief, is done using our strategic petroleum reserve like it's his own political fiddle. So anyway, wrapping up, everyone have a wonderful weekend. We'll catch you back here on Monday. Cheers.